Terminology. The following applies to both calls and puts. As I'm sure you know by now, a contract always involves two sides, a buyer and a seller. For example, Vic's restaurant and you, the insurance company and you, the pet shop and you. If you buy a call or put, someone is selling it to you. If you sell a call or a put, someone is buying it from you. Let's say I buy a call to open a new long position. The other party is either selling me the call to close their existing long position, or they could be writing and selling me a new call to open a new short position. Therefore, in your trading platform, there are two buy actions and two sell actions. You can either buy to open a new position, you can buy to close an existing position, you can sell to open a new position, and you can sell to close an existing position. If you own a call or a put, you can sell to close it at any given time. If you are short a call or a put, you can buy it back to close it at any given time. All right, in summary, if you're bullish, you buy to open one or more calls, and therefore you are long calls. On the other hand, if you're bearish, you buy to open one or more puts, and therefore you are long puts. Notice that I skipped over the red options because you are strictly forbidden from selling to open puts or calls. Selling to open puts or calls makes you short those puts or calls. And since you don't yet understand the ramifications of taking such an action, you are not allowed to even think about it, because you can blow your account. You can blow your account. The risk could be unlimited. Okay? In fact, until you have completed this course in its entirety, Course 1, Foundation, you're not even ready to buy to open calls or puts, because we have not yet addressed the topic of choosing the right option. So please, if you're bullish, you buy to open one or more calls. You don't even think about shorting puts. If you're bearish, you buy to open one or more puts. You don't even think about selling to open or shorting calls. All right, let's move on. Let's talk about what it means for an option, whether it be a call or a put, to be at the money, in the money, out of the money, deep in the money, near the money. Okay? At the money is easy enough to grasp. When the price of the underlying is the same as the strike price of the option is set to be at the money. And of course, this is true of both calls and puts. What's an at the money option worth at expiration? The answer is 0. Why? Well, if the strike price of the call is 108 and the price of Apple at expiration is 108, so the underlying here is Apple. So both the call option has a strike of 108 and the current price of Apple at expiration is 108. The call option is worth 0 because if you were to call away the stock at 108 and sell it back in the market at the current price of 108, you'd realize 0 profit. What's the point in calling away the stock if you're going to turn around and sell it at the same price that you bought it at? Okay, so the contract isn't realizing any profit for you. It's worth zero. By the way, here's a tip. Always ask yourself, what would my position be worth at expiration? In fact, learn to do this reactively every time you consider an options trade. Believe me, you will make things so much easier and simpler on yourself. Now let's talk about in-the-money call and put options. If the strike price of a call option is lower than the current price of the stock or ETF, which is the underlying, of course. So if the call option has a strike that is lower than the current price of the underlying, the call option is set to be in the money. In other words, its value is higher than zero. Say Apple's price at expiration is $108.20, and your call has a strike of 108. What do you think that call is worth at expiration? The answer is 20 cents. So the stock at expiration is trading at 108.20, and your call has a strike of 108. The difference is 20 cents, and that's exactly what your call is worth at expiration. Why? Because if you were to call away the stock at 108 and turn around and sell it in the market at the current price of 108.20, you'd make a profit of 20 cents per share. And that's why the call is said to be 20 cents in the money. Of course, here we're not factoring in brokerage fees or slippage, if you will. All right. Now, if the strike price of a put option is higher than the current price of the underlying, the put option is said to be in the money. In other words, its value is higher than zero. Say Apple's price at expiration is $107.80, and you own a put that has a strike of $108. What do you think your put is worth at expiration? Again, the answer is 20 cents. Why? Well, go ahead and buy 100 shares at the current price of $107.80 per share. That's what it's trading at expiration. Nothing is stopping you from buying 100 shares at the current price of $107.80 per share. Now, since you own the put, you have the right to exercise that put, and therefore you can go ahead and sell those 100 shares at the price of 108. You've realized a 20-cent profit per share. And that's why the put option is set to be 20 cents in the money. So make sure this becomes second nature to you. And don't forget to always ask yourself, what would happen at expiration if price is above my strike price? Or, in other words, if the underlying is trading at a price above the strike price of my option, or below the strike price of my option, or exactly at the strike price. Okay? If you own a call, you want the price of the stock to be trading above the strike price of that call. Otherwise, the call would be worth zero at expiration. If you own a put, you want the price of the stock to be trading below the strike price of the put. Otherwise, your put option would be worthless at expiration. Okay, now let's discuss what it means for a call option to be out of the money. Out of the money. If the strike price of a call option is higher than the current price of the underlying, the call option is set to be out of the money. In other words, its value is zero. It's worthless. Say Apple's price at expiration is $107. You own a call that has a strike of 108. $108 is the strike of your call. What do you think your 108 strike call is worth at expiration? The answer? Zero. Why? Because if you were to call away the stock at $108 a share and turn around and set it in the market at the current price of 107, you'd be booking a loss of $1 a share. You better not do it, you understand? It's a losing proposition. Therefore, the contract, the call option, is worthless. The call option is out of the money. It is said to be $1 out of the money. Of course, we're not factoring in brokerage fees or slippage, if you will. All right. The same goes for an out-of-the-money put. If the strike price of a put option is lower than the current price of the underlying, the put option is said to be out of the money. In other words, it's worthless. Its value is zero. Say Apple's price at expiration is $109. You own a put that has a strike of 108. What do you think your 108 strike put is worth at expiration? Answer again, zero. Why? Because go ahead and buy 100 shares of the current price of 109 a share, okay? Go ahead. It's trading at 109 a share at expiration. Go ahead and buy 100 shares at the current price of 109 per share. And then go ahead and exercise your put, your 108 strike put. You'd be selling those shares at 108 a share. Again, you'd be booking a loss of $1 a share. Better not do it. It's a losing transaction, and therefore the contract, which is a put option, is worthless. The put option is $1 out of the money. And that's what's meant by out of the money. There is no profit to be realized or even a residual value to be salvaged from exercising the option at expiration. Hence, the option is out of the money. It's worth zero at expiration. All right, let's move on. What does it mean for a call or a put option to be near the money? An option is set to be near the money when its strike price is close to the actual price, the market price, of the underlying. Generally, if the difference is less than 50 cents, the option is considered near the money. Now, your call or put option could either be in the money or out of the money, but it's also near the money if its strike price is within 50 cents of the current price of the underlying. So a put or a call option that has a strike price of 108 is near the money if the underlying is trading at 117.55, 117.70, 117.90, 118.20, 118.40, 118.48. All these are prices that are within 50 cents of the 108 strike. Okay, this leaves us with deep in the money, call, and put options. A call option is set to be deep in the money when its strike price is less than half the value of the underlying. Let's consider the case of the spider, symbol SPY. It's currently trading at $214 a share. Therefore, for a call to be deep in the money, it has to have a strike of less than that. Half of 214 is $107. Therefore, any call option with a strike price of $107 or less is considered to be deep in the money. Conversely, a put option is said to be deep in the money when its strike price is more than double the value of the underlying. So in the case of the Spider, which is trading at 214, a put option must have a strike of $428 or more for it to be considered deep in the money. To be totally honest with you, this is not a definition that I personally like. I like the definition of a deep in the money call or put option to be as such. Considering that the option has at least 1 month until expiration, 30 to 40 days until expiration, a call to me is considered to be deep in the money if it's moving like a stock, meaning for every $1 move in the stock, the call is appreciating or depreciating by $1, meaning if the SPY moves up by $1 from 214 to 215, the call option that has at least 30 or 40 days until expiration should move up by $1 to be deep in the money. And those are the types of options that are said to be moving or trading like the stock. Therefore, if you look at the SPY, and we'll look at that later, if we have a call option with a strike of say $190, and for every $1 appreciation in the SPY, in the underlying, the call option moves up by $1, I consider that personally to be a deep in the money call option, provided it's got 30 to 40 days left until expiration. This is a subjective definition of mine based on my experience with options. Conversely, deep in the money put option. Again, the put option must have at least 30 to 40 days until expiration. And therefore, if for every $1 loss in the underlying or fall, every time the underlying falls by $1, if the put option appreciates by $1, to me, the put option is considered to be deep in the money. We'll talk more about that later. Let's move on and examine the following options chain. What's an options chain? It's a partial or complete listing of all options available to you. In this case, I'm specifically looking at the calls expiring on September 16, 2016, with 3 days left until expiration. The Spider, symbol SPY, is currently trading at $216.34. Therefore, any call option that has a strike that's less than $216.34 is automatically in the money. And those are inside the green box on the screen. The near the money options are inside the black box. Those include the $216 strike, which is in the money, by the way, but only by 34 cents. Therefore, it is also near the money. And the $216.50 option, which is out of the money by about 16 cents. Okay? Out of the money options, they're inside the red box, and they have a strike price higher than $216.34. They're actually higher by at least 50 cents. Otherwise, anything within 50 cents would be considered near the money. Conversely, looking at the put options chain available, any strike price below $216.34 is considered out of the money. Those puts inside the red box are out of the money. The near the money options remain the same. $216.50. Those are near the money, per the definition of what a near the money option is. And in the green box are the in the money put options. Any put option that has a strike price higher than the current trading price, meaning $216.34. Any option that has a strike price higher than $216.34 is considered to be an in-the-money put option. Your broker's platform, the software platform, whatever that happens to be, if you're using TD Ameritrade, you have various options like Thinkorswim, Trade Architect, even a website interface. Those are the interfaces available for you to display your options chain and enter your trade. If you're using someone else like Schwab, they have a platform called Street Smart Pro. If you're using other brokers, interactive brokers, TradeStation, they have the same thing. They'd better have a software-based platform for you to visually inspect the options list and enter your trade electronically. Now let's move on to something else. Enough spent on this topic. Intrinsic value. We sort of brushed on that in the very first example, the Vic's restaurant pizza example. And be honest with you, you already know what an intrinsic value is. A call option is set to have intrinsic value if the current price of the underlying is above the call's strike. Well, guess what? We already know that if a call has a strike price that's below the current price of the stock or ETF, the underlying, that call is in the money. And therefore, only in the money calls have an intrinsic value. Because at expiration, the call option has a value equal to the value of the stock or ETF minus the strike of the call. If Apple is trading at 108 and you own a call that has a strike price of 107, the value of the call option at expiration is 108 minus 107 equals $1. As far as the put option is concerned, it is said to have intrinsic value if the current price of the underlying is below the put's strike. At expiration, if I own a $109 strike put option and the stock is trading at 108, my put option is automatically worth $1, 109 minus 108. Why? We talked about that a million times. I can go out in the market and buy 100 shares at 108 and turn around and exercise my put, selling those shares at 109 and collecting $1. Therefore, this needs to become second nature to you. The call's intrinsic value is either 0 or S minus X. Why would it be 0? Because if the call is out of the money, it's automatically worth 0. If it's in the money, it's automatically worth the value of the stock, the current trading price of the stock, minus the strike of the call, S minus X. Conversely, a put's intrinsic value is either 0 or X minus S. If Apple is trading at 108 and I own a put that has a strike of 109, my put option has a value at expiration of 109 minus 108 equals $1. However, if my strike was 107 and the stock is trading at 108, this put option is worthless. Because what good is it to go out in the market, buy the stock at 108, and then exercise your put and sell those shares at 107? You immediately lose $1, therefore you'd better not do it. An out-of-the-money put option is worth 0, just like an out-of-the-money call option. And that's what this example illustrates. Apple is currently trading at 108 a share. The intrinsic values of the 107 and 109 calls are 107, max of 0, or 108 minus 107 equals $1. Therefore, the 107 is clearly in the money, right? And the 109 call, its intrinsic value is 0 because it is out of the money. Very good. Example 2. If Apple is currently trading at 108 a share, the intrinsic values of the 106 and the 110 puts are, the 106 put is worth 0. Why? The stock is at 108. The put has a strike below 108. Sorry, your bearish bet didn't pan out. The stock never dropped below 106. Therefore, the intrinsic value at expiration is 0. The 110 put, however, retains a value of $2 because the stock is $2 below the strike price of the put. Okay, so automatically you are to assume that in the money options always have intrinsic value. The intrinsic value is always equal to the dollar amount by which it is in the money. And this will become second nature to you, like it has become to me, just by the force of repetition. You keep using options, you're always exposed to options, all that stuff becomes second nature. All right, we're on a roll, so let's continue. We already know what intrinsic value is, so the next thing I want to discuss is extrinsic value. In the previous slide, we talked about a call option having a strike of 107, and it was worth $1 at expiration because the stock was trading at 108. 108 minus 107 equals $1. Therefore, my call, which is $1 in the money, is worth $1 at expiration. But how about 10 days until expiration, or 20 days, or a month, or 2 months? Let's say that I pick a call option that has $107 strike 60 days from expiration. And at the time I buy this 107 strike call, the stock is trading at 108. I automatically know that the call holds an intrinsic value of $1. Because if I were to fast forward in time to expiration, this call will be worth $1. However, I'm still 60 days away from expiration. This call is probably worth more than $1 because I'm paying for the luxury of time. I'm paying to control those 100 shares of stock until expiration. What can happen between now and expiration? The stock could rocket up by 5 or 10 points. Okay? Therefore, the call option that has $1 intrinsic value must also have some time value, making it worth more than $1 until expiration. Okay? We know the intrinsic value is $1. But if you were to buy this call with 60 days or 30 days left until expiration, or 10 days, whatever, as long as there's still time until expiration, this call will be worth more than $1 if the stock is trading at 108. Okay? Let's say you buy it with 60 days left until expiration for $3 or $4. It's got a strike of 107, and the stock is currently trading at 108. Let's say the price of that 107 strike call is $4. The option price, $4, equals the intrinsic value, which we know is $1, plus the extrinsic value. We can solve for the extrinsic value. The extrinsic value equals the option price, which is $4, minus $1. Therefore, the extrinsic value is $3. You're paying $3 above and beyond the intrinsic value for the 60 days left until expiration. The luxury of having 60 days worth of time for the stock to perform. If the stock moves up to $120 in 60 days, your 107 call option will be worth $13 at expiration. So now you understand what extrinsic value is all about. And you can probably surmise that the less time there is until expiration, the less extrinsic value is in the price of the option. So the extrinsic value component of the option price is what you pay for the option above and beyond its intrinsic value, which can be zero, by the way, for an out-of-the-money call option. If the stock is trading at 108, we know that at expiration, a call that has a strike of 109 is worth zero. But that's only at expiration. The 109 call with 60 days left until expiration could be worth $2 or $3. And if the stock moves up to $120 a share before expiration, your 109 call, which was out of the money at the time you bought it, is now worth $11. Why? Because anything can happen between now and expiration. You're paying for the luxury of time. Time carries its own price tag. Again, a potential news announcement between now and expiration can cause the price of the underlying to explode or implode, by the way. So the opposite is true too. You could pay $3 or $4 for the 107 strike call with the stock trading at 108. But if bad news come out and the stock drops to 100, you lose your entire premium at expiration. So as a speculator, the extrinsic value is the time premium you pay for the surprise factor. Understood? All right. I love examples, so let's move on to example 1. I've already cited an example, but hey, you have it in front of your eyes right now. Let's talk about it. If Apple is currently trading at 108 a share and the price of the 107 call is approximately $1.96 with 10 days left until expiration. And by the way, I pulled this out of the options chain, so that's a real life example. The extrinsic value is the option price minus intrinsic value. Therefore, the extrinsic value equals the price of the option, $1.96, minus the intrinsic value, which is 108 minus 107. With 10 days left until expiration, you're paying 96 cents for having the luxury of time. So as a speculator, you're willing to pay a time premium of 96 cents above and beyond the intrinsic value of $1 because you're betting Apple's price will reach and exceed $100 a share, or 109 a share, with 10 days left until expiration. At expiration, if Apple's price is at, say, $112 a share, your 107 strike call will be worth exactly $5, and therefore yielding a profit of $3.04, excluding, of course, brokerage fees, slippage, if you will. In retrospect, the 96-cent time premium that you were willing to pay above and beyond the call's intrinsic value of $1 was worth the risk. Congratulations. Everything I cited in this example can be corroborated with the help of our options pricing calculator. In the topmost chart, I plugged in the price of the underlying 108 a share. I chose the call option that has a 107 strike, and I specified the current date, September 6th, and the expiration date, 10 days from now, September 16th. Automatically, the options calculator gave me the price of the call option based on the theoretical pricing model. And it said the call option should be worth $1.96. All right. So now, what if this price, the price of the underlying, moves up from $108 to $120? What would my 107 call be worth? Follow the green line. Draw a line, a red line, a vertical line from the 120 price mark up to the green line, and you can see that the price of the option is about $13. Why? 120 minus 107 is 13. In fact, there's a very small extrinsic value component, so it should be a little above $13 with 10 days left until expiration. At expiration, our green line is flat up to 107. You see, it coincides with the axis, the x-axis, up to 107, and then it becomes to rise linearly. Why? Because the call option has a strike of 107. If the stock closes at 107 or below, the price of the call is worth 0 at expiration. But if it closes above 107, simply follow the green line. At 120, it's worth $13. At 125, it is worth how much? 125 minus 107 $18. All right? Answer me honestly. Do you have a headache yet? We're almost done with the terminology section of this course. And we have one more example left to cement the concepts of intrinsic and extrinsic value. For this, I'm going to use Tesla as opposed to Apple. Enough with Apple. We've had so many examples revolving around Apple. In this case here, we have Tesla currently trading at $215 a share. And the price of the 210 strike put is approximately $1.71. We've got 10 days left until expiration. So the put has a strike of $210. The current price of this stock is $215 a share. And the price of the option is $1.71. Before we proceed, tell me, is this put in or out of the money? The put has a strike of $210. The stock is trading at $215 a share. If you own a put, what do you want the price of the underlying to do? You want the price of the underlying to fall below the strike price as quickly as possible. Well, it's currently $5 above the strike price of the put. Therefore, it is out of the money. This put won't be in the money until the price of Tesla falls below the strike price of 210. Okay, we've already covered that. I'm just repeating it as an exercise. So the extrinsic value per our formula equals the price of the option minus the intrinsic value. This option is out of the money. Does it have any intrinsic value? No, it's zero. Therefore, the entire premium of $1.71 is what? Time value. The entire premium is time value. So as a speculator, you're willing to pay a premium of $1.71 for an out-of-the-money put that has absolutely no intrinsic value because you're betting on Tesla's price dropping well below $110 within the next 10 days. Let's see if you've done your homework. Let's see if you've done your homework. At expiration, if Tesla's price is at 205, the 210 strike put will be worth exactly $5, yielding a profit of $3.29. So the $1.71 premium, which was entirely time value, paid off. So congratulations again. Another winning paper trade. Hopefully this knowledge you're acquiring, you'll translate it very soon into real money. All right, let's see if the options calculator corroborates our claims in this example. The stock is trading at $215. We chose a strike price of $210, so the put option has a strike price of $210. 10 days until expiration. Today is September 6th. Expiration is on September 16th. The put option per the options pricing model, the calculator, is $1.71. The green line plots the price of your option relative to the price of the underlying. Let's go ahead and pretend that on September 6th, the same day we bought the option, the price of the stock suddenly drops down to $205. The option, per the green line, automatically increases in value up to $6.62. Fabulous. Fabulous. Now, how about if we hold on to it until expiration? It drops to $205 and doesn't drop any further. At expiration, the option is worth $5 because it is $5 in the money and there's no more time left for it to do anything other than expire at 205. Time has run out on the option. It is $5 in the money. 10 days ago, you could have sold it at $6.62, but you had 10 days to go, and you thought maybe it'll drop to maybe, who knows, 200, 195. So you held on to it, and you still made money. What you bought at $1.71 is worth what? $5 at expiration. I want you to compare the green curve in the top chart against the green curve on the bottom chart. Notice that on the bottom chart, the green line coincides with the x-axis up to 210. Okay? In the top chart, it's actually above the x-axis. Why? Because 210 is the pivotal point, the crossroads. Your option has a strike of 210. If the stock at expiration is trading at 210 or higher, your option is worth 0. That's why in the bottom chart, the green line is at 0 up to 210. In the upper chart, it's not at 0. It is above 0. And that's the time value we're talking about. That's the time value that we're talking about. At 215, the green line is at $1.72. That's purely time value. But this time value erodes completely at expiration. There's no more time left, and therefore there's no more time value to account for. Okay?